Hey guys, a very good morning, good afternoon, good evening to our viewers from whatever location you are joining us. Happy to invite you for another episode of The Point. The Point is a podcast chat show where we have conversation with thought leaders and opinion shapers on different thematic issues affecting our society. And today's show, we are privileged to have a man who I will give him a chance to introduce himself and tell us who he is and what he does for a living. Before we have this conversation, from that point, we'll be able to introduce the subject matter of discussion. Thank you so much and karibu.
Asante sana.
Yes.
Yes. For purposes of this conversation, I'll
yes.
introduce myself.
Yes.
My name is Jared Osoro. I'm an economist. Essentially looking at the African economy at large. My entry point to the African economy is the financial markets. And financial markets, as you know, are at the center of what happens in the economy. So whereas my career interest has that focus, you cannot look at financial market in isolation to what happens in the rest of the economy. So I not only look at finance in a systemic way, but also how it integrates with the rest of the economies in the region. You can look at it from an individual economy perspective, but also look at it in terms of how the same economies are connected. So that's a very holistic way in which I look at the economics of financial markets. So that's what I do.
Thank you so much, Jared, and happy to have you on the show. For purposes of setting the record straight and again, for purposes of context, when we talk about money market, what are we talking about?
There's usually a confusion that I see on a regular basis about
Yes.
financial markets generally.
Yes.
Money markets are basically one component of the financial markets. The other component is the foreign exchange market.
Yes.
And many people tend to use them interchangeably and in a wrong way.
Okay.
When you talk about money market, it's basically a market in which people access, for instance, loans. And the price for the money market is interest rate. The other market, which I refer to as the foreign exchange market, the price is really the exchange rate. So when you talk about money market, you're basically looking at things like, the credit market. You're looking at things like the government securities market, and that is what constitutes the money market.
Thank you. Thank you. Paint for us the scenario. You are the expert here. The scenario at an African perspective before we delve on a Kenyan perspective with respect to you say we are the people who confuse money market and financial market.
Yes.
So draw the distinction for purposes of our viewers, and on what exactly is the situation like with a broader view at the African perspective before we delve into the Kenyan perspective.
Okay.
Yes.
So the African market is interesting.
Yes.
In many respects, but I can pick two.
Yes.
The first one is that when you're contrasting it with the advanced markets,
Yes.
you're basically looking to the extent to which the African markets, the African financial markets, are less deeper, and in some respects, depending on which economy you're talking about,
Yes.
dysfunctional. So there are markets which are very shallow financial markets, and there are those that have relatively deeper financial markets.
Yes.
And in the product classification of these financial markets, you hear people talk about emerging markets. And in Africa, we have economies that can be categorized as emerging markets.
Yes.
Economies such as South Africa, Mauritius in some respect, can be considered as emerging markets.
Yes.
And the reason why they're considered to be emerging markets is because now they slightly have a bigger integration with the rest of the financial markets globally. And the extent to which finance contributes to the growth of those economies is much deeper. There are some that are actually categorized as frontier markets.
Yes.
They are making strides towards being in the emerging category.
The emerging category, yes.
Finance is playing a bigger role, but not as big
Yes.
as what you can call the emerging markets.
Yes.
Now, the extent to which these markets are integrated with the rest of the global markets,
Yes.
is really the underpinning factor.
Yes.
Now, there are some markets that are fairly basic.
Yes.
they don't have an elaborate structure in terms of the diversity of the financial market players. Many of them typically are bank dominated, meaning that if you have a system where you only have banks as the core financial markets, then that is a bank dominated system. But there are those that have a diversity of players. There are those that have strong capital markets. And there are those that have not just capital markets, they have a strong insurance and pension sector. And there are those that have a very strong savings and cooperative society. So those are now speak to the diversity of the financial ecosystem. So when it comes to the African continent, those that are of course, in the emerging category clearly have a diversity of market players. But those that are moving towards the emerging, of course, differ in terms of the extent to which the diversity of the financial market players are playing so far as the economy's progress is concerned. Yeah.
That is the African perspective. What do you know about home?
Sorry?
What do you know about Kenya?
Yes. Okay. Kenya is actually a very interesting market. In the sense that, we've traditionally have had what you can call diversity of market players. Much as is still a bank-dominated financial system, we still have had the existence of capital markets for a very long time. And the capital markets are not just, the securities exchange. As you may know, that the Nairobi Exchange, which is now referred to as Nairobi Securities Exchange, actually existed even before independence. So that diversity has been entrenched historically in this market. And over time, we've seen a stronger now capital markets with a varied range of services that are offered there. At the same time, we've seen a strong and growing insurance sector. And now what is making it even more interesting in the Kenyan case is the role to which fintech or financial technologies is playing insofar as making the market stronger. So that makes the Kenyan market a bit more interesting than other markets in the same category. Okay.
Regionally in EAC, would you say Kenya is a pace setter with respect to financial markets?
Yes, you can easily say that without any fear of contradiction, because if you look at the markets, take for instance a very simple statistic. The assets of the banking industry in Kenya as a share of GDP is about approaching 50%. The next economy that is
following closely, or that would follow closely,
is Rwanda at about 35%. The rest are below 25%. So that's just one indicator. It's not a sufficient indicator. For you to understand how that now plays into what you can call sufficient indicators, start looking at the extent to which the Kenyan financial market players are moving towards the rest of the region. That speaks to the relative depth of the Kenyan financial system vis-a-vis the rest of the region. What we are not seeing is the rest of the region now moving into this market. It's not because there are any barriers that deliberately exclude them from this market, but the extent to which the levels of market competition is entrenching itself here. It's easier to see farms move from this market to the rest of the region.
So earlier, a while I was having a chat, and one of my guys was telling me that probably it's not that these farms in Kenya have the capacity to they're now growing. That's why they're moving out of Kenya. But probably it's because the ecosystem has become so much hyper-regulated in the sense that it makes thriving or survival becoming difficult. Is that the case?
That may not necessarily be the case, because when farms are moving across borders, theoretically you can argue that they are looking at what you can call regulatory arbitrage. You go to a market where there's less regulation.
It's less regulated.
But we are talking about a system that is increasingly converging from a regulatory standpoint. The financial market regulators in East Africa are basically looking at having a common platform insofar as regulation is concerned. So when you see farms move from one end of the region to the other, they're not basically looking at how they can get less regulation. Instead, they are looking at opportunities that arise in those economies because of the integration agenda. So when you see, for instance, banks move across borders, they are basically looking for two things. Either they have what you can call sufficient scale in the local market that allows them to move in those markets, or they think that by moving in those markets, it will be a platform for them now to scale up. So I think regulation differentials
Per se
is not really what you can call a driver for moving across the region.
Okay.
Yeah.
Others are also saying that fintech, the role of fintech is so much pronounced in Kenya than our neighbors. That also be a factor to the fact that Kenya is study ahead of the pack in East Africa.
It really depends on what level of fintech you're talking about, because fintech has always been there in the financial markets, only that it has been maybe on the back end. The fintech that people are talking about right now is really what's in front of your face, the products that are being channeled on the basis of the technology platforms. That's what many people think as fintech, but fintech has always been there.
It's beyond that. It's more than that. Yes,
it's more than that. So in the case of Kenya, I think it's obvious that Kenya is an early adopter of technology, and because of that, they tend to be ahead of the pack. So what tends to happen, therefore, is strive to replicate what has happened here in the rest of the region. That can be easily seen in the context of, for instance, mobile money. Mobile money riding on the platform of the mobile network operators, in collaboration with the financial market players. So the only difference that comes there is perhaps the point you raised earlier about regulation and the attitude towards regulation. Because you're talking about innovation around technology, there are two ways in which people tend to look at innovation. You can allow innovation to slightly go ahead so long as you have a mechanism of ensuring that it doesn't cause instability, or you may want to regulate because of fear that no innovation can come with risks. So I think Kenya, in my view, took the former. You allow regulation to thrive. You allow
the farms.
You allow innovation to thrive. And as it starts becoming systemic, then now you start looking for mechanisms of essentially regulating. And because of that, then you've started seeing even the efforts of replicating the successes of this market happening at varied speeds. Because if it has worked here, you could assume that you can just go and work it elsewhere. But I think the attitude towards regulation, insofar as innovation is concerned, maybe having those nuances depending on which country you're talking about. So that is really with respect to fintech and how it embeds itself in the financial markets.
Earlier on, you clarify that money markets is for want of a better word, a subset or a form of financial ecosystem. Is it fair to conclude that money market is gaining traction more than the bank deposits?
Okay, the thing is, when it comes to how you look at the financial ecosystem, we don't look at it in isolation because there's a lot of interaction that happens between the various subcomponents of the money market. So let me give you an example of how the interaction happens within the financial markets. You have firms that operate within the financial ecosystem. These firms are essentially competing. They're competitors in the sense that they're looking for the same set of customers. They're looking at the products that are not necessarily differentiated. Similar products. In that respect, they are competitors. But financial markets operate as a system. In the sense that there's even a market amongst those players themselves. So because of that, there's a lot of interaction, not just amongst the various subcomponents, but amongst the players themselves. That's where, for instance, we have an interbank market. If banks are competing for common customers, but they also have a market amongst themselves. And this interbank market happens both on the money market side, where they lend each other either on an overnight basis or on a longer term basis, but there's also an interbank foreign exchange market. So these markets are very connected. And if you drill it now to perhaps the macro policy, when, for instance, the central bank is pursuing a certain monetary policy stance, the way it filters to the market and then to the final end of the economy depends on where it thinks it hits best. When you, for instance, you adjust the the central bank rate.
Right, yes.
You expect it to be transmitted through the money market because it affects the interest rates.
The interest rate, yes.
Now, that's a money market channel. But the adjustment of the monetary policy may actually have an implication on how the foreign exchange market behaves. And that's why there was a very big conversation around the recent move, for instance, by the Central Bank of Kenya to tighten monetary policy
Yes.
on the back of pressure on the exchange rate. So that tells you, therefore, that those markets, much as you have a temptation of looking at them separately, actually have a connection.
Connected. They have the connection.
Yeah.
At the risk of digressing, the tightening of the MPC monetary policy, would you say it achieved the desired objective?
You see, it's very tempting for you to want to see results being achieved. Whenever there is a policy move, particularly monetary policy, you tend to look at the lag between when the policy decision has been made and how that policy decision has actually led to the anticipated outcome insofar as markets are concerned.
Yes.
Now, as you may appreciate, the mandate of monetary policy is towards price stability.
Yes.
And that's inflation. So the temptation number one comes, if inflation has come to within targets, as it is right now,
yes,
you may argue that monetary policy has been very successful.
Yes, it has achieved its objective.
Yes, but the reality could be fundamentally different from that.
Yes.
Especially when inflationary pressure is arising from the supply side. The tools of monetary policy are not attuned to supply side. They are meant to influence the demand side.
Yes.
So if inflation comes to target, that tends to, of course, give the central bank relief in the sense it doesn't have to be aggressive in terms of tightening.
Yes.
But then the other moving parts here, if your currency is under pressure,
yes,
you're not going to start now pursuing an accommodative monetary policy because your inflation has come within target. And that's because there could be pressure from what you can call the exchange rate pass-through effects to inflation that may make inflation emerge down the road.
Yes.
So essentially what that policy stance does is to entrench what's called anchoring low inflation expectations, meaning therefore that no, should inflation start going above the target, then the expectations of the public and everybody else of interest in that space, that the central bank will move to make sure that it contains it. So it's not an obvious thing that the objectives are being met.
It's not a switch on, switch off.
That's the thing.
Yes.
Yes.
Thank you. In the recent past, the opinion is divided and it varies from who you speak to about what could have led to the behavior of our shilling against the dollar. What say you?
You know, I think the exchange rate markets over the last couple of years, I must say, has been subject to what I can call the tyranny of expertise. Everybody has an opinion as to what
happened or what didn't happen or what's about to happen. Yes.
That's the thing. But the true picture has to be seen from the context of one, what are the fundamentals that support the currency movements? Now, if the fundamentals are weak, then of necessity, you expect the currency to adjust. Because exchange rate is a relative price, and therefore it adjusts depending on whether you have fundamentals that are strong to support either stability or movement in a certain direction. But the fundamentals are just one part of the story. There's what you can call the market sentiments. What does the market read? And the market can read things from as simple as what pronouncements have been made by which politician on which occasion. And then from there, they try to read, markets try to read what that means in so far as
what it portends.
Now, in our case, I think we've had a number of things that worked towards the currency moving in the direction that it did. If you step back towards the end of 2016, 2017, there was a very big debate between the Central Bank of Kenya and the IMF as to whether the currency is rightly valued or it's overvalued. And the conclusion of the IMF was that I think there was room for the currency to adjust. In plain English, they were basically trying to say that I think this thing is managed at some level. So if it's allowed to adjust, then it will reach to its appropriate level. And the thought process behind that was that, you know, your current account as an economy is widening. The current account is the difference between the receipts you make
Yes.
out of your exports
Yes.
Compared to how much you spend
Yes.
on what you import. So if your current account is widening, it simply tells you that you're essentially relying on foreign savings for purposes
yes.
of your domestic investment and consumption.
That happens when you're a net importer.
Yes, that's simply what happens. And when that happens, you need to look at how your exchange rate as a relative price adjusts. So we saw a situation where the current account was widening, and yet the currency was not adjusting.
Yes.
So then that will tempt one to think that maybe there was some form of intervention that was meant to assure stability in that regard. Now, the question that one can ask yourself is, why do you want to have a sticky exchange rate on the back of you having an open capital account? An open capital account simply means that you have a policy stance that allows inflows and outflows out of the economy without any restrictions. So that then points you to potential reasons why you may want to have a currency that doesn't move, that is relatively sticky. And I think it has nothing to do with, in my mind, the monetary policy stance. In the sense that, if you fear that, movement in currency is going to be inflationary, there are quite a number of studies that I've seen that show, yes, there's what you can call the foreign exchange pass-through effect to inflation, but it's not a strong move of inflation. So the fear that, a movement in currency is going to lead into inflationary pressure, I think was at the second level. To me, I think the fear was more about what it means insofar as public debt is concerned, if there was a swing in the exchange rate. And the only risk with that is that you're going to expend the reserves that you have to kind of,
you rely on the reserve savings.
Yes, to assure the movement of the currency does not swing that much. Until you realize that you don't have sufficient reserves. And when the market reaches that, of course, it will start having pressure to move. And that's what we saw when the currency started moving very drastically. And that now has serious ramifications insofar as, the problem that you're trying to address in the first place is concerned. So that is really what you see in that space. But the one point that I probably may want to make is the fact that, there is always this, and you see it amongst analysts, that just like in the animal farm, where 2 legs were considered to be bad and 4 legs were considered to be good, any depreciation is necessarily considered as a bad thing, and any appreciation is necessarily considered to be a good thing. I think that view needs to be given a nuanced perspective, in the sense that, sometimes your currency can adjust in a manner of depreciation towards a correction. If you have an imbalance,
some form of self-correcting.
Yes. So that is one. And secondly, if an appreciation is very drastic, like what we saw in the recent past, that is a characterization of what we can call market volatility. Volatility is not one way. Volatility is 2 ways.
Either way.
So I think, to me, a responsible way of looking at the currency is to make sure that you don't really expend a lot of your intellectual energy on the direction in which it moves. Instead, you think about, is it moving in a manner that is volatile? If it's not volatile, then the movements are healthy. So that's really my view regarding what you've seen in the exchange rate market.
Okay, thank you. So, back to our conversation, in light of all that, is it very easy or difficult to invest in our financial ecosystem? What would be the risks, or what would be the things that people should know before they make that
an investor basically is looking at the return. And your return can only be anticipated if there's an element of stability. So if you see prices, financial prices, be they interest rates or exchange rates, moving in a manner that is random and in a manner that reflects volatility, then I think investors will sit back. But that depends on which investor you're talking about, because many people tend to think that investors are necessarily, foreign investors. We have local investors too. And both classes of investors are looking at a sense of stability, because when you have markets that are volatile, then obviously it means that you're not going to have an opportunity to take a forward view as to how your returns will look like.
So they would prefer a predictable market.
Yes, any investor will prefer a predictable market. And predictability should not just be looked at the very end in terms of the price. The underlying policy environment that can assure you to take a view on how the market will be going forward is, I think, something that is going to be of interest. So if there's a concern that the underlying policy environment is unpredictable, then I think that will make them the investors to be a bit more risk averse.
How do you characterize our market currently? Would you say it's volatile, or would you say it's predictable?
I think there are some broader policies that are predictable. One is that we are basically market-led economy, in the sense that we don't see a lot of interference insofar as the markets are concerned. So that is one predictable policy. The second is that we are an open economy in all respects. We have an open capital account, and that, if you see some of these indices that classify the way the market is moving, you get a lot of credit for pursuing an open capital account as an economy. So those are really what you can call predictable policy environments. What becomes unpredictable is when you have what you can call the response to erratic market movements that can trigger a sense of temptation towards intervention. When markets move drastically, you're not going to sit on your hands and say that, look, let the market address itself.
Let it correct itself.
Let the market correct itself. It may take forever to correct itself, or it may correct itself in a wrong direction. So the end of either a policymaker to address those drastic movements may actually in some ways be interpreted as interference, especially because it may be very difficult, first, to determine the pace at which you're going to intervene to correct, and secondly, the direction in which you're going to intervene to correct. So in that regard, you can say that in a broader sense, we have a conducive environment for investment, but then one has to watch to what extent you can have those unpredictability from a policy response standpoint.
You've put it clearly on what exactly would mean to be able to make a decision of investing or not. Would you say politics has a role in influencing investment decisions?
Of course, there's no investor, I think, who doesn't look at the political economy side of things, because the politics anchor what you can call the policy environment. Many people, especially those who watch the financial markets, think that the policy is formulated at the regulatory level. Far from it.
It's from the political class, then the regulator is just an implementer, an enforcer.
Essentially, the policy tone is set at the executive level. And then the regulatory agencies will have to now essentially police that policy environment. That's why their mandates are usually fairly narrow. And in that regard, you cannot say that they have a bigger hand in the broader sense of policy. So, to the extent that the executive is a creation of politics, you may not actually rule out
the influence of politics on all this.
Politics insofar as investment is concerned. So I want to imagine that an investor who has taken a very long-term view to an economy may want to see the kind of political environment around which they want to invest. If it's a very noisy environment, and that noise does not translate into a damaging policy environment, investors are not going to take off. It's easier to argue that the politics in Kenya around the time of elections can be very noisy. But that has not damaged the fabric of that policy predictability in terms of the underpinning open market.
When you stretch this conversation a little bit slightly, would you say that explains the behavior of the economy? Because when you look at the GDP numbers, Kenya as a case study, right from 1964, when we had the first election, to 2022, it's only 1988 and 2007 when the GDP numbers growth went a little bit up. But all those other election years, they slumped down. Do you say it's because people are apprehensive of what might happen after elections, and the whole discussion of the politics and how it would, the aftermath of it, that has a huge bearing on investment decisions that both local and outsiders make.
I think you probably have to be a bit more deeper in your analysis of the economic cycle vis-a-vis the political calendars or the political cycle, so to say. In the sense that, if the economy is driven substantially by sectors such as agriculture,
Yes.
then you're not going to make an accurate case by saying that has mapped into an election date, and therefore elections or politics it has a causal effect to the outcome of the economy insofar as performance is concerned.
Yes.
I think the extent to which politics could have an influence is how external investors perceive the market. And that is not going to be revealed in your GDP numbers. It's likely to be revealed in those high-level market numbers that I talked about. Either you have what we call portfolio reversals from the capital markets, and that can reveal itself either in the interest rates or the exchange rates, but not necessarily in the real output of the economy. I think it would be stretching to argue that the politics affect the performance of the economy around an election cycle. The only time that I think you can argue that is when we had the misfortune of a very violent episodes around election. And that, of course, is because it affected the actual production.
Yes.
Yeah.
Okay. Thank you. Fine. As we switch to the last part of this conversation on financial innovation, what is financial innovation in your understanding? And help us put into perspective whether there is a nexus between financial deepening and economic growth or growth in general.
Okay.
Yes.
So I think the term financial innovation has been given very many meanings.
Yes.
To me, financial innovation simply means offering the same financial services that have been historically offered, using much more efficient technologies or modalities of delivery, essentially doing the same thing, but in a much more efficient way. And that's where technology has come in, because we've not seen an emergence of products in the financial ecosystem that are different from what used to be there. There used to be credit, there used to be payments, only that they used to be done in a manner that was a bit basic. Now technology has come to support the offering of new products and doing things in a new way. Now you can argue, therefore, that technology has been at the forefront in driving that innovation. There are two things that I think you probably have to layer on top of that innovation. It has tended to, in a way, formalize the financial ecosystem, in the sense that because you're using technology, that has enabled you to at least have some records, and those records are going to be meaningful insofar as your future access of financial services is concerned. So that's one aspect. The second, it has brought in new players in a space that was basically constrained insofar as who are the people offering financial services. Now that is what you can call the benefits, the easy benefits you can see from financial innovation. But that benefit must be seen alongside the emerging risks, insofar as the new way of offering finance is concerned. One of the risks, of course, is it could in some way come with risks such as cybersecurity, which was not there when finance was being offered. That's not necessarily a bad thing, because what you do is you look for mechanisms for addressing that. Because now you want to make sure that the advantages of innovation outweigh any risks that are underlying these emerging things. The second is the fact that because there new players
Yes.
who have come into the space, many of whom may actually not be within the purview of the regulatory environment as we know it,
Yes.
may lead to some unethical practices among those players. And you cannot regulate everybody.
Yes.
So because of that, you might find that either there is households becoming trapped
Yes.
in the consumption of new financial products in a manner that's detrimental to welfare.
Yes.
And therefore, beyond looking at what you can call being included because of technology, we have now to start having a conversation around the quality of inclusion,
Yes.
the financial health that comes with
inclusion,
with inclusion and innovation.
Yes.
So that's the first component of your question. Second is about the nexus between financial depth
Yes.
and economic growth. I think that is intellectually a settled conversation.
Yes.
If you have a deeper
Yes.
a financial system, obviously that translates into more entrenched economic growth and development.
Yes.
And the reason is because the more people become integrated in the financial system, the more you lessen informality.
Yes.
So essentially you're using finance as a way of cutting the informality trap. So there's some people who are caught in that trap of informality and therefore they're not able to break it. But if you see finance playing a bigger role, then many people are moving from informal to formal, and that tends to address that problem. So I think the nexus, the depth of finance and economic growth nexus is something that I think I can comfortably say is fairly settled. And that's why many of the economies that we aspire to be like have very deep financial systems. And to my mind, there's no debating on the fact that maybe it's a depth is the strong growth of those economies that led into deeper financial systems.
Yes.
The causality may run both ways, but I think to me a deeper financial system obviously has a direct connection to economic performance.
Okay.
Yeah.
Kenya is a largely informal economy. Or differently, there is a lot that happens within the informal economy than the formal economy. Would you argue that acceleration of financial deepening would be a shot towards formalizing the informal?
Yeah, I think that is an interesting one because it really depends on what you mean by informal. Because many people tend to assume that if you're operating small scale,
yes,
you're necessarily informal.
Yes.
And that's a debate that you can have. There are those who, for instance, if you look at agriculture, 70% of agriculture in Kenya is smallholder agriculture.
Yes.
And therefore not necessarily commercial. So, and the 30% is what you can call commercial agriculture.
Yes.
Now, it's very tempting for you to say that the 30% is formal and this other is informal. But that may not necessarily be accurate because informality is not a function of size.
Yes.
Increasingly, as I said, if you have even small enterprises that are now working very closely with the financial ecosystem, that way they are tending to formalize themselves and therefore in a way lessen informality. That of course does not take away the broader factor. We still have a huge component of the economy that is informal. We have very informal labor markets.
Yes.
That I can tell you for a fact.
Yes.
And the funny thing is that unlike historically when you used to have rural to urban migration, where people are moving from the rural areas to come to the urban areas to work in industry and therefore move into formal labor markets. What we are having now increasingly is informal rural labor moving into informal urban jobs.
Yes.
So that tends to be something that I think one can think about. So the accurate thinking around informality and formality or formality or lack thereof
it's the labor
economy,
aspect.
in the labor market is something to think about. So it really depends on which segment of the economy you're talking about. But I think to my mind, so long as you're seeing more people taking advantage of financial services to create a track record, that tends to diffuse that informality. The next level essentially will be then to see whether if you're operating a small business, you're not operating it as a subsistent, where you
Hand to mouth. It's a
yes,
lively program.
yes.
That is.
They can formalize it by either registering those businesses and all that. And the infrastructure is increasingly there. We have bureaus for business registration that are able to track that. Yeah.
There are those who argue that those who resist being included financially, those who want to continue operating on the size of tax avoidance. Is that an argument you hold?
Well, the thing is, it depends on which tax you want to avoid.
Yes.
If it's direct taxation, maybe there will be that temptation. But I think you may not go very far because of the deliberate effort of widening the tax base. If it's indirect tax, of course, you're not going to avoid it. But I think the question is really a matter of what you can call the cost benefit. The benefits of being formal may actually outweigh the temptation of wanting to be formal because you want to avoid paying tax.
Yes.
So to me, I think the lure of avoiding or tax and therefore remaining informal does not compensate for the benefits you get by actually being formal. Yeah.
What are some of the risks that are still prevalent in our financial ecosystem, and what do you think needs to be done, whether it's from a promoter perspective or from a regulator perspective, to ameliorate those risks?
The financial market is really about risk management.
Yes.
And you're not going to have a financial ecosystem that doesn't have risk.
Yes.
It's really how you manage those risks.
Yes.
And I think, to me, there's a very big tension between the understanding of the financial market from a risk management standpoint and from a progress standpoint. It's in finance where you have two people with contradicting ideas being considered to be novel at the same time.
Yes.
And I don't know whether you recall that in 2013, the Nobel winners in economics were guys with divergent views.
Yes.
One guy called Robert Shiller was talking about irrational exuberance and how markets sometimes mislead completely the signals. The other guy, on the other hand, called Eugene Farmer, was talking about perfect markets and how when you see a price in the financial ecosystem, then it gives you the full information about the given market. Now, because of that, there's usually that tension in the market. Now, the reason why there's a lot of emphasis on strong regulation, but the regulation that is not on the face of the market players is that, without what you can call optimal regulation, you stand the risk of going to the dimensions of the global financial crisis of 2007-2008. Now, what we have is not exactly that kind of environment.
Yes.
Because there's quite a bit of that has been learned over time in terms of what to regulate, what aspects to regulate.
Yes.
But in terms of how you manage the risks, so that you're able to have a thriving financial market, is to appreciate that risks are not necessarily out of your day-to-day doing business.
Yes.
Risk can come from other dimensions that are not necessarily business. There are policy risks and stuff like that. And the other dimension I think this is really emerging is the attitude of the financial market themselves towards developments.
Yes.
If you look at, for instance, the players in the banking industry in the recent past, you see them talking about, we have made very good returns because we've been able to take advantage of risk-free investments and stuff like that. What they tend to forget is that, there's what you can call the doom loop, where, the acknowledgement that, there's no investment that is risk-free is something that I think they probably have to start now
considering,
acknowledging, explicitly acknowledging. The second is the fact that, your exposure to some segments that you consider to be risk-free is something that I think they also need to accept, because if, for instance, your attitude towards those so-called risk-free investments is confronted by the reality that, the people that you're investing in have challenges, then you have what we can call a doom loop. Yes. Where in the event of a challenge in the financial markets, for instance, you expect government and by extension taxpayers to sort out the the financial markets. And if the problems are on the sovereign side, you expect the financial system to offer solution. So you have what we call a loop that goes around. So in the totality of things, the position of what's called risk has to be seen in a broader sense. There are many risks that I think now are becoming very embedded in the financial ecosystem. Not very many years ago did people start acknowledging that, you know, climate-related risks are going to be something that financials are going to think about critically. And now this really at the top of the level.
It's a reality. Yes.
Because if you don't look at how the people that you funded operate, then you'll be confronted with an asset that is subject to serious climate risks. So risks are dynamic, and so should be risk management.
They keep on evolving with time.
Yes. And the risk management tools also have to evolve with time. And those have to be seen from both the market side, the policy side, and even the political side, as we've said.
Is Kenya doing enough to help in managing or mitigating those risks within the financial ecosystem?
Well, the thing is, it's not about Kenya doing enough. It's about what the market players are doing. The market players really have to be on top of the game. Nobody's going to tell you how to manage your risks. Just that you have to know that those risks have to be undertaken within some specific safeguards, as assured by both the regulators and even the owners of the business themselves. Because you know, there's something called risk appetite, and not all players have the same risk appetite. So if you're risk aggressive, then you have to do that in a manner that does not jeopardize the entire system. And as I said, the players in the financial ecosystem are indeed a system. There's a connection between them, and that's why, you know, there's what you can call contagion. You know, once something happens in one end, may end up being contagious to what happens in the rest of it.
Thank you. From a government perspective, we say that markets are diverse, and there are numerous markets within the financial ecosystem. Within the foreign exchange market, where the price is the exchange rate. Would you say there are moments when a government or a sovereign is forced to manage the currency?
Well, the thing is,
what we call propping.
It goes back to what I said is the underlying fundamental policy. If you have an open capital account, that of necessity requires you to have a floating exchange rate. And this is an idea that has also been tested. And so with that, in that regard, then you don't expect anybody to be managing, so to say, the currency. I think what then you need to look at is whether the infrastructure, the market infrastructure, can be able to support a floating exchange rate in a manner that does not necessarily engender volatility. And that infrastructure entails looking at things like how functional is the market amongst the players themselves, what you can call the interbank market, for instance. If you have segmentations within the interbank market, then you're not going to have a smooth exchange rate market. Even if there is a market that is devoid of government interference. The second is, and this is among the new dynamics over the past two decades or how you signal policy, how you communicate policy. Because it's through how policy is communicated that the market is able to read the intention of the policymaker. So clarity insofar as communicating, especially to sensitive markets like the exchange market, is extremely critical. If you communicate in a way that gives the market the discomfort that maybe we are going to have a problem, then the market will panic. And you'll see that panic revealed.
To reflect. So
communication is
very critical. Thank you. As we head to the last bit of this show, I was asked, Duncan, when you're meeting Jared, please put this to him. There is a sense with which, I know you don't speak for banks, and
I don't. I think it's.
I wouldn't invite you to speak for banks, but as an observer in this space, of late we note with concern that the banks have appetite of doing business with the government. Obviously, one would argue it's because the government gives them a higher rate. But do you think it is having a crowding out effect, or it's a good thing, it's a way to go? Why the credit is not largely is increasingly becoming unavailable to individual borrowers. It's largely, they would prefer borrowing, lending to the government than to Jared and Duncan.
Okay, so I think that's an important question. And this is what you started with the preamble that I don't speak for banks.
Yes.
Now, there's nothing, first of all, unethical in banks doing business with government.
Yes.
Because the reality is that the government is a very, very important participant in the financial market.
Yes.
So doing business with the government is not something that we should shun or look at as unethical.
Yes.
Far from it, it's not. But having said that, I think if you're doing lending to government at the expense of the rest of the economy,
yes.
what you're calling crowding out effect,
yes.
Then you tend to do that. It may make you profitable, but it may end up actually hurting the rest of your portfolio.
Yes.
So there has to be that balance between, to what extent do you want to go that route, and if you go that route,
yes.
how is it going to have an impact
yes.
on the rest of your portfolio?
Yes.
That's just one argument. The other argument that one can make is that how does crowding out effect happen?
Okay, yes.
There are two ways in which you can look at crowding out effect. One is called the quantity channel, where actually the amount of resources that you're actually supposed to be giving the private sector goes to government.
Yes.
So that's the quantity side of things. There's what you can call the price channel, where by you responding to the incentive of government giving you a high interest rate, it forces the interest rate in the market to be higher, and therefore make it difficult for other people who could have otherwise gotten credit, unable to access it. So those are the two sets of dimensions that you need to consider. But the third, and which is not spoken about often, is there's a limit beyond which you cannot continue lending to government, however good the incentive is, what you can call the threshold effect. So if you continue lending to government at higher interest rates, that will have the effect of making the government itself debt unsustainable.
Yes.
And you stand the risk of actually not getting that return back. So this conversation around is really investing in government securities entirely risk-free.
Yes.
And the answer is no.
Yes.
And if the market blindly wants to respond to that high price, then they will go into that trap of pushing the government into what you can call unsustainable levels.
Yes.
So those are really the dynamics that you have to talk about when you're looking at this thing called lending to government.
Yes.
And lending in a way that supports the economy.
Yes.
Not necessarily in a way that hurts other segments of the economy.
Yes.
But usually these things are not as straightforward as I'm putting them. There are so many other dynamics that underline
that come to play,
that come into play that cannot make it as obvious and no. And by the way, it's not really what you can call a binary choice that if I lend to government, I'm not necessarily going to lend to the private sector.
Yes.
You can have a balanced portfolio.
Yes.
Because you can imagine if the government comes to the market for purposes of what can call liquidity management, and there's no liquidity in that end, then it will also hurt you indirectly. And that's why you need to look at it in totality. As opposed to saying that lending to government is bad.
You can't look at it in isolation.
Yes.
Thank you. The very final thing, talk to us about T-bills, T-bonds. Is it something that you encourage private investors at local level to invest in? Because people are skeptical about doing business with government because I don't know that the default rate of the government is high. I don't know what are the permutations. So as an observer who has observed this market for some time, is it something that you'd encourage you and I know Kenya is a gambling economy. So people who have proceeds from gambling, would you encourage them to invest in T-bills and T-bonds? Okay,
see, I don't know whether you can call economists good investment advisors. I don't want to pretend to be an investment advisor.
Yes.
All I'll tell you is this. If you trust your money with your bank, and that bank is putting money in government securities, then you have an exposure right there. So whether you want to invest in government securities or not, you're already exposed indirectly to government securities. So if you want to put money in either treasury bills or treasury bonds, then the question you ask yourself is, what is the alternative return you could get from other investments?
The opportunity cost if you have to invest.
And if the opportunity cost is putting it in fixed assets that not necessarily that may appear to be secure but not having a return, or if it's the money that you put that is sitting in a bank account, then you probably have to start looking at some of those investments positively.
Yes.
Because in any event, you're putting your deposits in a commercial bank.
Yes.
And that commercial bank is giving you a return that may not be comparable to what the government is giving in government securities. But the same bank is investing in those government securities. So in Excel,
either way,
it ends up going there. So I think it's one thing that you need to look in that balanced manner that you can go that route and. Of course, when you talk about investing in government or doing business with government, you're not likely to see a default from that end. You can imagine the extent to which the government has gone through the pain of making sure that they don't default on the Eurobond.
Yes.
And it's more difficult to avoid a default on your borrowings in a currency that is not yours.
Yes.
It's much easier to, avoid a default on your borrowing in a currency that is yours, because what you do is that you can either lengthen the maturity profile or all over, even if it comes at a cost.
Yes.
Where the government is a defaulter is essentially on what called these other services.
Yes.
What Kenyans call pending bills.
Yes.
And those are different. Those are different
things. Yes.
Supposed to to put this up.
I know I said finally, but I remember my director asked me to. There's a question that came from our viewers that you, for a minute, tell us or tell our viewers why is it that IFB infrastructure bonds, why are they tax-free as opposed to these other bonds?
Okay, I think they are tax-free because they are trying to incentivize people to lock in resources towards infrastructure on a longer-term basis. So that's really is an incentive of making sure resources.
So we're incentivizing them.
Incentivizing them. But it should not end there, because the question to me is that are those infrastructure bonds really going to infrastructure?
Yes.
Because if they are true infrastructure bonds, then they should be ring-fenced. Yes. And you can say that no, these resources are going towards this particular infrastructure.
Yes.
And the proceeds out of that infrastructure is supposed to be going to repay
those bonds.
But those are fungible. Those are fungible securities. So once you get the proceeds, you can deploy them as you think
as you wish.
So that means, therefore, that maybe, and this may appear controversial, that infrastructure bonds, yes, a label, but the interest component is just what you can call an incentive. And I think it should not just be looked at it in terms of the infrastructure bonds only. I think you can start thinking broadly and go to, for instance, if you issue a green bond.
Yes.
To my mind, there's no reason.
Not everyone had the benefit of going to those schools you went to. What is a green bond?
Yes, a green bond is basically a security.
Yes.
Like an infrastructure bond that is meant to what's the acquisition of an asset that addresses the environmental or green dimensions. So it's the same way as what you can call a vanilla or a regular bond.
Yes.
But the difference is the assets that is going to finance. So if you are willing to give you incentives towards an infrastructure bond for an infrastructure project that is not defined, then it makes more sense to give the same incentives.
Absolutely.
Towards a green fund, so that you don't have what called asymmetrical incentives for instruments that have similar benefits or even more benefits. So that is really what I can say is something to think about.
Thank you so much, Jared. It's been an exciting. I regret not carrying my notebook and a pen.
No.
This is a show that will be available. I can as well go and watch.
No, thank you.
And learn a few things. And
this has been exciting.
Very exciting, and I'm very sure even our viewers would find this relatable and interesting. And should they call upon us to invite you one more time, trust you me, we will not hesitate to do that. For a minute, look at this camera. Speak to the viewers. On any issue that you feel you needed to pass across. It could be a reflection of what we've discussed, or an area you wanted to emphasize on as we wind up.
Okay, I think we've had a good conversation around the interaction between the financial sector and the rest of the economy.
Yes.
To me, it would be more exciting to look at, in a granular way, how finance enhances welfare at the household level. Because many people tend to look at finance as high level, and that's why conversation around financial inclusion really speak to how finance addresses matters welfare. So drilling it down to household level and how finance can make households have enhanced welfare is something that I think is very important, because finance tends to be abstract if it doesn't have an implication on households. So that's really something that I can say as a parting shot.
Thank you so much.
Yeah.
Thank you so much, Jared, for a well-articulated and well-inspiring conversation that I'm very sure it has served the purpose. At the point, we are threefold in terms of objective: ours to inform, educate, and impact. And trust you me, this conversation out there, you'd find viewers who would wish to relate with it, or this is what they've been looking for as a way of clarifying things for them. We thank you so much for having this conversation. And we invite those who have not subscribed to our channel to subscribe to The Point YouTube, and also follow us on X at The Point TV Show. Feel free to make suggestions on guests you'd want to see on the show. Ours is to reach out to them and invite them on the show. Thank you so much for the production team and everybody who has made this possible. I have been your host, Duncan, and until we do this some other time, thank you so much, and asante sana Bwana Osoro.
Thank you.
Thank you.
Asante.